In this video, I'm going to show you the power of pyramid entries, how you can utilize that for your trading, and give you a real example of how I did last week. So jumping right over to the charts, we're going to look at TradeZella. Looking at this example that I have in recent trading, we're going to break down exactly what I'm doing and how I'm able to position with the most size possible. So looking at the chart, we're going to go ahead and just make this a full screen setup. Now, with a trade like this, I'm going to break down the exact logic as to why I thought this was a good trade. We have right here is the new day gap opening. So I'm going to go ahead and outline some levels for you so you get a bit of a context on what I am looking at. With that kind of downward motion, you can see that price had popped here, but that was simply a manipulative move or a shakeout or however you want to look at it. So with that in mind, I was able to use this area to enter my first position. Now, my trade did not trigger until down here using the 5-minute. That trade did not trigger until we get down to this level. This is going to be my order block or change in state. And I added my initial, added another. And what did I do here on this pop that went against me is I simply added to the trade on the basis of a swing point forming. So in this video, I'm going to give you a couple pieces of information as to when it is appropriate to add to your trade, and ultimately use this example to walk you through my process on how to add to trades consistently. Now, with this level in mind, right here, my risk is somewhere up here, right? So maybe it's above this wick, maybe it's right here, and when this thing kind of pops, maybe I'm kind of flirting with it, right? I want to see how this is responding. And when I see it pop and kind of consolidate like this tells me this is a very likely swing formation. Now, a swing formation is important because that's essentially going to be my new risk point or somewhere that I would consider adding to a trade. So once it starts to break down and you see this follow through, I'm able to have my stop right here with extra contracts. So instead of it being up here, I'm now down here. And probably as soon as this pushes, waiting for like this swing to form, I'm probably putting it right there. So my net risk is never greater than 400 bucks. I'm using a handful of micros in this example. And as you can see right here, I took off one contract down here, just one. I didn't scale out all crazy. I had probably 30 at this point or 20, but I only took off one just to take off one at that point. And where did I look to add? Well, again, it's that same idea. Because I have so much equity up here in my position and we have this positive move, that means obviously I have profits that I can play with. So my break even is probably up here, right? Or right here, or wherever it is, it's somewhere up here. But with that in mind, I can add to the position as long as it's less size than my initial trade. Because if I have 20 up here and I can add maybe 5 or 3 or whatever, it marginally will move my trail. It will marginally move my average price, but it will never knock me out of being in a profitable trade. So how do I look to add to this trade as it continues? Well, I'm going to go ahead and use this new structure here, maybe this fair value gap right here, as my risk point. So if I'm adding here, I obviously don't want to get stopped all the way up here. So I may move it to about right there and kind of wait for it to, form 3 drives and kind of top out. Maybe at that point, that's where I put my stop. So now I have more contracts plus more equity if I get trailed. So again, how else do I add to this trade? I basically wait for pops, such as this right here. You can see we create a little inverse gap. That alone is enough for me to be able to get in a trade and potentially have my stop up here, right? It does it again. I don't get swept out or anything. Add to it again. Cool. And then right here was the continuation entry. You can add on these, right? But they might pull back on you. That's why it's really important to not add the bulk of your position when you're very extended into the move. All I'm doing is simply squeezing out profits by adding little tiny bits into the trade. Now, again, it pops up. I add as it starts to roll over. My trail isn't necessarily right there. My trail is still in this area because I have a lot of equity in the position. And as it starts to roll over again, this is that backside where I aggressively start to trail the position. And I'm able to get out the majority, or actually the entirety of my position down there. This trade, I had a couple key points in mind. If I'm adding to a trade, it doesn't mean that I necessarily want to extend my targets. I almost want to tighten my targets. So as I'm adding to a trade, I'm trying to make it to where it's just an easy hit. And as it gets extended into the move, I'm trailing it aggressively. So on that final drive, I did miss out on the peak profit of about 5,000 there, but I was able to secure 4,200 as it started to roll higher. So I'm going to look at this chart real quick. A couple things that I want you to consider when scaling into a trade and doing it the right way versus the wrong way. We'll start here. You need an advantaged first entry, meaning your first entry's got to be good. You got to get somewhere near the top, the reversal, so that you have room to play with the average price. If your entry's up here, or if it's a long and it's at the very, very, very bottom, if it's with 10 contracts, you can add on every pullback 1, 2, 3 contracts. It's perfectly fine. The math will even out so that you're never in jeopardy of the trade flipping against you. In addition to that, you need to have reasonable range left in the move. Now, I don't recommend blasting the top or blasting the bottom. Notice how I always added on a pullback so that I could have some sort of cushion when it started to move. And as soon as it started to confirm the move, I would trail it to help protect the profit. The only reason I'm willing to add to a trade is because I see a new risk point. So I'm able to base a new trade onto it. That means my invalidation is based on that as well. And then finally, you need microstructures like I showed you, swing point formations, order blocks, fair value gaps. You need something that's going to confirm a bullish structure. So on all of these trades, my main objective was essentially down here. I was aiming for these lows on this 15-minute. I never quite got there. However, I was able to trail and hit that pretty closely. And then it gave the move the next day, as you can see. However, this video is simply just showing you that you can add to positions when you have a great entry. If your trade is hundreds of points in profit or hundreds of dollars in profit, and you're seeing structure that's telling you the trade's still valid, you can add. There's no rule against it. It actually will help you a lot because having more size in a position matters more than having like the perfect entry. You have the perfect entry so that you can afford to add into it. It gives you room, it gives you cushion. But the difference between my average price being 560 and then by the end of this trade, I believe my average price was probably like closer to 520 or 530. I'd rather have more contracts at a lower price because it equals more profit. Compare, if we had 20 contracts here, which we did, down to here, 70 points, that's a decent day. But with 50 contracts, we're able to get more out of that move. It's a trade we're already taking. We're just simply looking to supercharge our best plays. So hopefully you found something in this video insightful. These are the same types of strategies I'm using when I'm adding to trades. If you're trading futures, it's a brilliant way to get more out of the moves you're already catching. So if you enjoy this type of content, be sure to leave a like, share, comment down below. And until next time, we'll talk soon.